It's Monday, 13th of August, and you're back in business with me, Harsha Subramaniam on Bloomberg TV India. On Earnings Edge, Bharat Forge reported a modest 9% growth in sales. The slowdown in automobile demand is beginning to show on Bharat Forge. Joining me now, in fact, is Amit Kalyani, Executive Director of Bharat Forge. Amit, many thanks for joining in. How do you see demand for automobiles playing out? Are you seeing visible signs of a slowdown?
See, I think, obviously there isn't a very buoyant sentiment in the automotive industry, but it's not dire and, gloom and doom either. I think there are quite a few assignable reasons why there is a slight slowdown in the automotive industry. Cost pressures is one, interest rates being high is the other. Third is, availability of diesel models. Everybody wants diesel vehicles, especially these small diesel cars. Now, because of the Manesar issue, one of the prime producers of these vehicles is unable to produce enough vehicles. So, people are actually probably postponing purchasing decisions. So, I think it's a combination of all these factors. And, we are all very optimistic people by nature and hoping that, with the new changes in the portfolios in the government, hopefully some fiscal stimulus or some kind of a push will be given to consumption and which will help the automotive industry in the second half.
Amit, just looking at your numbers, do you see your non-auto business contributing higher revenues in future? Do you see the revenue mix shifting towards non-auto more and more as you go along?
See, if we look at our non-auto business, as we've stated, we had a target of 40%. We've already reached that 40% goal. And I think that going forward, definitely we will see continued growth in non-auto. But I want to re-emphasize that as a company and as a management, we have put a lot of effort in growing our auto business. And you will see some bumper growth in the auto sector coming also in the next 2 years. So yes, while we will see growth in non-auto, we also want to push a lot of growth in auto sector.
You'd articulated a 5 billion rupee capex plans. Have all those additional capacities come on stream? How much are you factoring that in at the moment?
No, not yet. Actually, most of our expansions have not yet come on stream. Out of that 5 billion rupees, about 3.8 billion rupees or so was for machining, or maybe 4 billion rupees was for machining, and about 1.2 billion rupees was on the forging side. Now the forging investment is not yet operational, and less than half the machining investments are operational. So when those come online, they will also add significantly to top line and bottom line, of course.
Finance cost is up about 75%, Amit. What is the total debt on your books? How do you plan to pare this down?
Our total debt is about 1400 crores and we have about 650 to 700 crores of cash on our balance sheet. Okay, and for a company which generates close to 250 crores of EBITDA per quarter, that's not a very large amount of debt. Our interest costs have gone up largely because we paid off our FCCBs and we replaced them with an ECB. So you went from something which had 0.5% coupon to something which now has 5.5% interest.
Fair point. Half your revenues, of course, come from exports. The sharp fall in the rupee has given you some gains this quarter. What's the level of the rupee that you're comfortable with?
See, basically the rupee has behaved, it's basically come to the underlying value of the rupee. The rupee has depreciated because of deficit. And, we have no, let's say there's no sign of deficit being under control, GDP growth slowing down. Rupee is bound to weaken. There's no inflows into the country. Although this has happened, this has had a very detrimental impact on certain input costs for companies like us, basically in the areas of energy, because our energy costs are linked to imports. Whether it's imported coal or it's imported oil or gas, these are all direct imports which are now 20 to 25% more expensive. But on the other hand, exports are obviously slightly more remunerative. But we have not had the advantage of having the full rate of the rupee dollar being at 54, 55 because we had we have a normal process of taking a rolling forward cover. So our rupee realization per dollar is still slightly below 51 rupees or in the 51 rupee range.
But Amit, if you leave aside the rupee gains for a moment, how do you expect to improve on your margin performance? And that's something that the market wants to know quite keenly.
Absolutely. I mean, we are working very hard to improve our margins, to improve our return ratios. The whole focus, if you look at our balance sheet, what it says is, the sowing is over, it's now time to harvest. Basically, we're not going to make any big ticket capital investments. We have a lot of assets and now it's time to sweat them hard and to generate significant incremental returns from them.
One final question, Amit. To your mind, given the uncertain environment that you're seeing, both as you say in the export market and in the domestic market, what are the risk factors for Bharat Forge as you move along?
See, one of the things that we have worked very hard on over the last 5 years is de-risking the business. If you look at some of the underlying economies, medium heavy commercial vehicle down 40% quarter on quarter, China down 40-50%, US now slowing down, Europe being down 15-20%. In spite of that, we have positive growth, we have good profits. This is de-risking. Now, obviously, if the whole world suddenly economically implodes and we have a situation far worse than 2009, all bets are off. But bottom line is you create a strategy where you're the last man standing and you always got a great shot at making it work.
Amit Kalyani, we'll leave it there. Many thanks for joining us with your perspective. That was Amit Kalyani of Bharat Forge. The stock is down on trade today. But up next in business, signs of stress in China. Andy Shea, former chief economist of Morgan Stanley, says it's a bubble waiting to burst.
Well, what's going on in China is a big bubble. And first the stock market bubble, then the property market, and there are tons of financial stuff going around.